OpenAI is the kind of company that seems to break the normal rules of business. The more people use its product, the more expensive success can become. At first glance, the model looks familiar because ChatGPT behaves like software, sits behind a simple interface, and can be sold as a subscription. That normally sounds like a dream business, because software can be copied to another customer at almost zero marginal cost. But an AI answer is not copied from a finished inventory. It has to be computed again every time someone asks for it. So OpenAI is not merely selling software licenses. It is continuously manufacturing intelligence inside data centers and delivering it one response at a time. What is the contradiction behind the headline that made OpenAI famous in finance as well as technology? In October 2025, OpenAI completed a recapitalization at a reported valuation around $500 billion, making the number a symbol of the AI boom. By 2026, later reported private market valuations had moved even higher, which is a reminder that private company valuations can change dramatically between financing events. Yet the more important number is not the valuation investors place on OpenAI today, but the amount of cash the company must spend to justify tomorrow. The Financial Times reported that OpenAI generated about $13 billion of revenue in 2025, while spending roughly $34 billion during the year. Also reported an accounting net loss near $39 billion, although most of that headline loss included a large non-cash restructuring charge. Strapping out major non-cash items, the same reporting put OpenAI's operating loss at roughly $8 billion, which is still enormous by normal software standards. That gives us the central question of this story. How can one of the fastest growing technology companies in history still require so much money to keep growing? The answer begins with a fact that is easy to miss whenever ChatGPT feels instantaneous and effortless. Every useful response consumes scarce physical resources, including accelerators, memory, networking, electricity, cooling capacity, engineers, and data center space. The user sees a chat box, but the company sees a bill of materials for computation. The simplest screen in consumer technology can therefore hide one of the most capital-intensive supply chains in the world. And unlike a traditional app, the bill does not stop after the software has been developed. Cost follows the user into every conversation, every generated image, every coding task, and every long reasoning session. That means usage is simultaneously OpenAI's strongest evidence of product-market fit and one of the biggest pressures on its economics. See why follow a single prompt from the moment a user presses enter until OpenAI either earns a margin or subsidizes the answer. The prompt first becomes tokens, which are small mathematical units that let a model process language as numbers rather than as ordinary words. OpenAI then sends those tokens through a model containing an enormous number of learned parameters, contributing to the probability of what should come next. The model does not retrieve one finished paragraph from a database. It generates an answer token by token while repeatedly performing large amounts of matrix math. This stage is called inference. Inference is where the abstract idea of artificial intelligence becomes a recurring operating expense. OpenAI's current API pricing makes the structure visible because customers are billed separately for input tokens, cached input and output tokens for GPT-5. 6 Sol. OpenAI currently lists standard prices of $5 per million input tokens and $30 per million output tokens. The gap matters because producing output is usually more computationally expensive than simply reading the input context. Customer asking for a short classification may therefore be economically very different from a customer requesting 50 pages of code or a long research report. The interface can look identical even when the cost beneath it differs by orders of magnitude. It's the first hidden mechanism in OpenAI's business. Revenue is often sold in simple plans, while cost is created by complicated patterns of behavior. $20 subscription sounds clean because every customer appears to contribute the same monthly revenue. Two $20 subscribers can impose completely different costs, depending on how often they use the system and which models or tools they trigger. One person may ask 10 short questions a week, while another may run long coding agents, upload large files, generate images, and use deep reasoning every day. The subscription price is fixed, but the computational burden is not. This is why OpenAI uses limits, model routing, caching, credits, rate controls, product, and different product tiers. Instead of treating every request as economically identical, the company is constantly trying to make the user experience feel unlimited while keeping the underlying cost from actually becoming unlimited. Tension is easiest to understand by comparing ChatGPT with an old-fashioned media business. A streaming service pays for content and bandwidth, but once a movie is stored, serving another viewer is relatively cheap compared with producing the film again. Frontier AI system behaves differently because the expensive computation happens again every time the audience interacts with it. The user is not simply watching the product. The user is activating the factory. Here's why OpenAI's fastest growth can create a strange cash flow problem in which demand arrives before the infrastructure required to serve it economically. Reuters reported that OpenAI's annualized revenue exceeded $25 billion by the end of February 2026, up sharply from late 2025. That growth is extraordinary, especially for a company that had almost no commercial revenue only a few years earlier. But annualized revenue is not profit, and multiplying one strong month by 12 does not reveal what it cost to create that month. If each new dollar of revenue requires a large commitment to chips, data centers, researchers, and electricity, growth can consume cash rather than release it. This is where OpenAI stops looking like a normal software company and starts resembling a capital-intensive industrial platform. A conventional software company often invests heavily before launch and then benefits from expanding gross margins as more customers arrive. OpenAI must invest before launch, during launch, after launch, and again, when the next generation of models becomes necessary. Its product cycle does not end when a model works. A successful model can actually increase the pressure to build the next one faster. It creates a race in which revenue growth and capital requirements can rise together instead of one replacing the other. Training a frontier model is the most dramatic version of this spending, because thousands of advanced accelerators may operate together for long periods. But the training bill is only the first chapter, because a popular model can spend years generating answers after its initial training run is complete. A useful mental model is to separate OpenAI's economics into two factories: the research factory that creates new models and the inference factory that serves customers. The research factory consumes compute, researchers, experiments, data, and time without guaranteeing that the resulting model will become a commercial winner. Inference factory begins only after the model succeeds, and its job is to serve enough paid demand at a low enough unit cost to recover everything else. These factories are connected because a better model can attract more customers, but it can also be more expensive to train and sometimes more expensive to serve. That is why a benchmark victory does not automatically translate into better economics. A model can be smarter, more popular, and more impressive while still producing weaker margins than a smaller model optimized for routine work. OpenAI therefore has a strong incentive to route easy requests toward cheaper models and reserve expensive reasoning for tasks where users actually value it. Model routing is not just a technical optimization. It is a pricing strategy hidden inside the product. If a simple question can be answered by a cheaper model without the customer noticing a meaningful difference, the margin on that interaction improves instantly. Caching creates another advantage by reusing previously processed context instead of paying full price to process identical information repeatedly. Batching can combine work more efficiently, while specialized hardware and better kernels can squeeze more useful tokens from the same amount of electricity. Small engineering improvements matter, because OpenAI operates at a scale where fractions of a cent can become millions of dollars when repeated billions of times. That's why the company's real competitive advantage is not only model intelligence, but the cost curve underneath that intelligence. If OpenAI can make each useful answer cheaper faster than users demand more expensive capabilities, margins can improve even as the product becomes more powerful. If user expectations rise faster than efficiency, the opposite happens, and every new feature becomes another reason to buy more infrastructure. The biggest example is reasoning, where customers increasingly expect models to spend more computation before answering difficult questions. Longer reasoning can improve accuracy, but economically, it means the company is selling a product whose quality may depend on deliberately using more compute per request. That sounds backward compared with normal technology, where improvement usually means doing the same job with less work. In AI, product sometimes improves because the system is allowed to think longer, search more sources, run more tools, and generate more intermediate computation. The business challenge is therefore not simply reducing compute, deciding when additional compute creates enough customer value to justify its cost. This becomes especially important as ChatGPT evolves from a chatbot into an agent that can perform multi-step work on behalf of a user. A chatbot may answer once, while an agent can browse, write code, call tools, revise its work, and continue operating for minutes or hours. Each extra action can create more tokens, more model calls, more tool usage, and more chances for the final task to become expensive. Customer experiences convenience, but OpenAI experiences a chain of variable costs hiding behind one button. This helps explain why the company is experimenting with multiple ways to monetize the same underlying intelligence. Consumer subscriptions provide predictable monthly revenue, but heavy users can pressure margins if their usage grows faster than pricing. That peak buyout pricing exposes usage directly, which gives OpenAI better protection because customers pay more when they consume more tokens. Business and enterprise plans sell security, administration, integrations, and organizational deployment, rather than merely selling access to a single model. OpenAI's business plan is currently listed at $20 per user per month when billed annually, with a higher monthly option. Enterprise contracts can be more valuable because large organizations may commit substantial budgets and build OpenAI deeply into workflows that are expensive to replace. The company is also expanding advertising on lower-priced and free plans, creating a revenue stream that does not require every user to become a subscriber. That advertising strategy matters because a billion-user consumer product can be strategically valuable even when most of those users never pay directly. A parent customer may therefore not always be the economic customer. A free user can create training signals, distribution, habit, brand dominance, and future advertising inventory, even if the current conversation produces no subscription revenue. Free usage still consumes infrastructure. So OpenAI has to make sure the long-term value of that audience exceeds the cost of serving it. This is one reason the company cannot simply maximize engagement, the way a social network once tried to maximize screen time. A social network can show more ads as usage grows, whereas a generative AI company may incur significantly more compute before it earns another advertising dollar. The economics become even more unusual when OpenAI sells enterprise tools that replace human labor rather than merely entertain users. An agent can save a company $10,000 of employee time. OpenAI may eventually price the service based on value rather than raw token cost. That would be a major shift because the most profitable future of AI may come from capturing a fraction of the economic work it performs. In that world, tokens become an internal cost unit rather than the thing the customer thinks it is buying. A law firm does not really want tokens. It wants faster research, a bank wants better analysis, and a software company wants working code. The closer OpenAI gets to selling completed outcomes, the more pricing power it may gain over pure commodity compute. But moving toward outcomes creates another risk because customers will expect reliability, accountability, security, and measurable business results. The company must therefore improve both intelligence and trust while continuing to lower the cost of delivering each successful task. This is where OpenAI's enormous research budget begins to make more sense, even if it remains financially painful. The Financial Times reported that research and development accounted for about $19 billion of OpenAI's 2025 spending. That figure reflects a company behaving less like a mature software vendor and more like a laboratory trying to invent the next computing platform. Research spending includes far more than one training run, because frontier development requires failed experiments, evaluation, safety work, data pipelines, infrastructure, and highly paid talent. Most experiments do not become products, but the winning experiment may determine whether OpenAI stays ahead of Google, Anthropic, Meta, and fast-moving open model competitors. It creates a classic arms race problem. Even if slowing down would improve short-term profitability, slowing down can increase the risk of losing the market. The company is therefore spending partly because opportunity is large and partly because competition makes restraint dangerous. A business that could theoretically become profitable by reducing research may destroy the very advantage investors are valuing. That is why OpenAI's losses cannot be understood simply as evidence that the product does not work. They are also evidence that the company is attempting to finance a technological lead before the economics of the market have fully stabilized. The most important question is whether that lead becomes durable enough to generate cash later, or whether competitors make the models increasingly interchangeable. If models become commodities, pricing falls, customers switch easily, the companies with the cheapest infrastructure may capture most of the value. If OpenAI's products become deeply embedded in work, identity, memory tools, and enterprise systems, switching becomes harder, and margins can improve. The difference between those two futures is worth hundreds of billions of dollars in valuation. This brings us to the second hidden system behind OpenAI. Its dependence on companies that own the physical infrastructure it needs. OpenAI became famous as a research laboratory, but at scale, it is also one of the world's largest buyers of advanced cloud computing. For years, Microsoft supplied capital, Azure infrastructure, and commercial distribution, while receiving rights to OpenAI technology and a share of revenue. The relationship helped OpenAI avoid building every data center itself, but it also meant a portion of OpenAI's success flowed back to its infrastructure partner. In April 2026, Microsoft said the partnership had been amended again to give both companies more flexibility as the scale of AI infrastructure expanded. Microsoft remains a major shareholder and primary cloud partner, while OpenAI can now serve products across additional cloud providers under the revised arrangement. Microsoft's license to OpenAI model and product intellectual property continues through 2032, but the license is now non-exclusive. The companies also said OpenAI's revenue share payments to Microsoft continue through 2030, subject to an overall cap. That detail matters because OpenAI does not get to treat all of its reported revenue as money available for salaries, research, or new data centers. Some revenue is effectively part of a larger bargain that helped finance the company's rise. This is another reason a headline revenue number can look healthier than the underlying cash economics. OpenAI has responded by diversifying where it gets compute and by helping organize infrastructure on a scale that would once have sounded absurd for a software company. The clearest example is Stargate, the infrastructure initiative associated with OpenAI, Oracle, SoftBank, and other partners. OpenAI said in 2025 that Stargate was on a path toward a $500 billion, 10-gigawatt commitment in the United States. That $500 billion number is not OpenAI's annual spending bill, but it reveals the industrial scale of the infrastructure ecosystem being assembled around future AI demand. 10 gigawatts is a power requirement measured more like heavy industry than traditional software. The existence of projects like Stargate tells us something important about what investors believe OpenAI could become. They are not funding a chatbot. They are funding a new layer of computing infrastructure that may sit between people, companies, and digital work. The same infrastructure creates a dangerous chain reaction if demand or pricing disappoints. First, OpenAI commits to more compute because usage and model ambitions are rising. Fide-Trocken partners then finance data centers, chips, power connections, leases, and networking based partly on expectations that OpenAI will keep needing more capacity. If OpenAI's revenue grows as expected, those commitments become productive assets and the system reinforces itself. If demand slows, competitors cut prices, or models become dramatically more efficient, the same long-term commitments can become a burden. The risk can then travel backward from OpenAI to cloud providers, data center owners, lenders, utilities, and chip suppliers. Reuters has highlighted this broader issue in 2026 as large technology companies accumulated enormous future lease commitments connected to AI data center expansion. Oracle is especially exposed because analysts and rating agencies have scrutinized its leverage and dependence on massive AI infrastructure commitments. That matters to OpenAI because the economics of its product are now intertwined with the balance sheets of companies building the factories that serve its models. A chatbot failure would look like a software problem to the user, but at industrial scale, the financial consequences can spread through physical infrastructure. This is the point where the phrase AI company becomes misleading. OpenAI increasingly sits at the center of a supply chain connecting investors, chip makers, cloud providers, data centers, utilities, enterprise customers, advertisers, and consumers. Its success depends on keeping all of those groups convinced that future demand will be large enough to justify today's commitments. Confidence is one reason private market valuation matters, even though it is not the same thing as cash in the bank. A high valuation allows OpenAI to raise enormous amounts of capital without giving away as much ownership for each new dollar invested. Financial Times reported in 2026 that OpenAI had raised roughly $122 billion and was valued around $730 billion in that financing context. Reuters has cited an even higher recent valuation in discussing possible future public market offerings, showing how quickly reported private valuations can move. The exact number therefore depends on the transaction and date, but the strategic function is the same. Valuation is fuel for capital formation. This explains why OpenAI can be financially unprofitable and still become more valuable at the same time. Investors are not paying for today's earnings. They are paying for the possibility that OpenAI becomes a dominant platform before the market matures. That is similar to earlier internet and cloud businesses, but the scale of required infrastructure makes the bet more extreme. The company must prove not only that AI demand is real, but that it can eventually convert that demand into durable margins after paying for computation and partners. OpenAI's corporate structure adds another unusual layer because the commercial business is not controlled like an ordinary venture-backed technology company. OpenAI began as a nonprofit in 2015, created a for-profit subsidiary in 2019, and reorganized again in 2025. Current operating company is OpenAI Group PBC, a public benefit corporation, while the OpenAI Foundation remains the controlling entity. Structure is designed to combine access to enormous amounts of private capital with a mission that is supposed to remain broader than shareholder profit. Economically, that creates a company trying to optimize three things at once: technological leadership, commercial returns, and a public benefit mission. Those goals can align when better products create more resources for safety and research, but they can also create tension when growth requires enormous spending. The recapitalization was therefore not just legal housekeeping. It was part of the financing machinery required to keep the AI race going. $500 billion valuation milestone mattered because it converted OpenAI's perceived future dominance into a financial asset that investors and partners could act on. Yet the case study becomes more interesting when we compare that valuation with the company's reported 2025 operating performance. The story begins with explosive adoption, rising subscriptions, API usage, and enterprise demand that pushed revenue into the tens of billions. The peak of optimism came as investors valued OpenAI like a future global platform rather than a conventional software vendor. The first warning sign was that infrastructure and research spending were rising almost as dramatically as revenue. The turning point came when the company had to prove that revenue growth could eventually outrun research, inference, and infrastructure costs rather than merely accompany them. That proof is still incomplete because OpenAI remains private, and many of the most important financial figures come from reports rather than audited public filings. What we can say confidently is that demand is enormous, reported revenue growth is extraordinary, and reported losses remain very large. We can also say that the company is responding by raising prices for premium capabilities, selling enterprise products, charging usage-based API fees, optimizing models, diversifying compute, and expanding advertising. Those moves all attack the same underlying problem from different directions. OpenAI needs more revenue per unit of useful work while simultaneously reducing the amount of compute required to produce that work. If it succeeds, today's losses can look like the temporary construction cost of building a dominant platform. If it fails, today's valuation can look like investors capitalized decades of future profit before the industry proved those profits existed. Optimistic outcome is that AI becomes a basic layer of the global economy, and OpenAI captures a meaningful share of the value created by billions of automated tasks. In that world, enterprise agents, APIs, subscriptions, advertising, and new products generate enough revenue to cover research, while falling compute costs expand margins. The realistic successful outcome is less spectacular, but still enormous. OpenAI remains one of several major AI platforms and earns healthy margins on premium, enterprise, and developer usage. The negative outcome is that models become cheaper and more interchangeable faster than OpenAI can build switching costs, forcing prices downward while infrastructure commitments remain high. Failure scenario is a combination of slower demand, aggressive competition, weak pricing power, expensive compute, and capital markets becoming less willing to fund continuing losses. That combination would not necessarily make AI disappear. Simply transfer value from model companies to chip makers, cloud providers, open source ecosystems, or downstream applications. This is the most important distinction in the entire story, because a revolutionary technology does not guarantee that the company most associated with it earns the best returns. Railroads transformed economies while many railroad investors lost money. Airlines changed the world while often producing poor margins. And the internet created fortunes unevenly. It can follow the same pattern. Enormous social value, enormous usage, enormous infrastructure, surprisingly difficult economics for some of the companies at the center. So when you see OpenAI described as a $500 billion company, remember that valuation is not a giant profit account sitting inside the business. It's a market belief about what OpenAI may eventually be able to earn, defend, and control. The company is effectively borrowing against the economic importance investors believe artificial intelligence will have in the future. Every new user strengthens that story, but every new user also creates another workload that somebody has to compute and somebody has to pay for. Every smarter model strengthens the product, but developing it can require another wave of research spending and infrastructure. Every enterprise contract improves revenue visibility, but servers in those enterprises can require reliability and capacity commitments years into the future. Every efficiency breakthrough lowers costs, but it can also help competitors build cheaper alternatives and pressure prices across the market. This is why OpenAI's economics are not a simple contest between revenue and expenses. They are a race between intelligence, efficiency, distribution, pricing power, and the cost of capital required to keep all four moving. The company does not need compute to become cheap in absolute terms. It needs the value created by each dollar of compute to rise faster than the cost of supplying it. That is the hidden equation investors are really betting on. The best evidence for the bullish case is that users and businesses continue finding more valuable work for AI to perform, allowing OpenAI to monetize outcomes rather than conversations. Best evidence for the bearish case is that competition and efficiency can push the price of intelligence downward, faster than any one company can defend its margins. Both forces are operating at the same time, which is why the industry can look like an unstoppable boom and a dangerous financial experiment simultaneously. The answer to whether OpenAI can make money is therefore not simply yes or no. It depends on whether the company can turn a massive audience into high-value recurring work before the cost and price of intelligence collapse toward commodity levels. That is what makes OpenAI more interesting than a normal software company and more risky than its simple chat interface suggests. The visible product is a conversation, but the hidden business is a giant machine converting capital, electricity, chips, research, and human attention into increasingly valuable digital labor. And the final economics come down to one question. Can OpenAI make that machine produce value faster than it burns money?